Hi, this is Jim Cunningham. I have Christina Lindsay from Ascent Wealth Management here today. Here, we're going to talk about critical 401k year-end planning for business owners. And as always, this is information only. Christina and I are going to be talking about a lot of stuff, a lot of legal stuff, a lot of financial stuff. But please bear in mind that watching this video does not mean that you're a client of ours. We can certainly talk about that, but this is purely information only. If you're watching this on YouTube, subscribe to our YouTube channel. You can hit the button subscribe. This will pop up in your feed. And there's a lot going on in the world now and in the near term, and it's really important to pay attention to this. I'm an attorney. I've been an attorney for over 25 years. We have offices throughout California. I'm a certified specialist in estate planning, trust and probate law, real estate broker, securities, and insurance licensed. Most people want to pay less taxes, right? Christina, we were talking before we started here today. Who is this for and what's it for? Okay, so if you are a business owner and you feel like you're making too much money, what I mean by that is you feel like you're paying too much in tax. This is a really effective, tried and true, it's like middle of the road. I don't want to say conservative, but you're like taking no risks with this, but this is something that the government has just teed up for American business owners to help save for retirement. And so Christina is going to go through a few examples and really educate us today on what business owners can do to reduce the amount of money that they send every year to the state and federal government. So Christina, you're a certified financial planner and you're one of my partners at Ascent Wealth Management and a great person to work with. So with that, I will let you take it from here.
Thanks, Jim. Yes, so we've been, I've been working together for quite some time. And one of the things that we really cater to is business owners. And so income tax planning is just becoming an ever-growing conversation, especially with business owners in California. When you have your top marginal bracket, in California, you're at 53% when you're all in. So one of the common issues in dealing with business owners is, what do we do to mitigate taxes? And 401ks is, a simple kind of often looked at as a employee benefit. And most companies these days, in order to have competitive employment, they almost always have some form of a retirement plan. So 401ks are kind of common. Oftentimes they are still overlooked when you have small business owners where you have under 5 employees or you have just husband and wife or just family. You can still do what's called a solo K, an individual 401k if it's just family members. So 401ks don't have to be just big corporations. They're very commonly used in small businesses, but there are various different ways of adding additional retirement plan benefits to your company that could also save significant taxes. And so what we want to start with is, your typical 415. This could honestly be if you're a business owner or an employee. The 415 limit is 58,000 can go into a 401k each year. Now, that could be a Roth 401k, which means it's going to grow tax-free and it's going to come out tax-free. There's no pre-tax savings there, but it is a way to allow things to grow tax-free.
Christina, can I just ask you a question here? So there's the 401k space. We're not talking about 401ks today, right? We're talking about something else. Is that correct?
This is talking about really adding on additional bells and whistles to a 401k. It can either be done in conjunction with or standalone.
Yeah. And so I will tell you, you mentioned something that I think is really important, and business owners, especially today, and this is October of 2021 that we're talking.
Yes.
We're in the middle of something called the Great Migration, which is a bunch of people are quitting. And every single business owner I talk to says, I'm pulling my hair out. I got to deal with COVID. I got to deal with employees working from home, COVID exposures, shutting down offices. I've got, we were doing a lot of cleaning and now that's been throttled back a little bit. So there's a lot going on in the business world. The other thing is California recently passed a law that says if you have, is it more than 5 employees or 5 or more? Very small number of employees.
I don't know that it's Yeah, and it's not even necessarily just California. I think California is the first to implement it. It's like a federal law that if you don't have a 401k or some sort of benefit plan to save for retirement for your employees, if you have over a certain amount of employees, you're going to have to participate in a state run, which sounds awful for California running anything for regards to my retirement plan. So you don't want to be dealing with a state run retirement plan. Those are really for, it's not going to be a competitive edge as a business owner to have to participate in a state-run retirement plan. Anyone that's currently already doing a 401k or a simple IRA or a SEP or anything like that for their company is not going to be subject to these plans. This is for people that have nothing. But one of the things we want to focus on here is adding a potential defined benefit plan or a cash balance plan. And those are two new topics that are new to a lot of people. And if it's something that may make sense for your business, it has to be implemented before year end. And so what we want to get ahead of is doing some tax planning with our business owners, reviewing your profit and loss and your current year-to-date P&L. And are you looking at a trajectory of higher profits and higher taxes? And if adding one of these types of plans makes sense, again, we just can't wait until December 31st and do a plan document. So these really need to be done in the next 6 to 8 weeks. And
just on a high level, Christina, I'm looking at these numbers and you get I think for a normal person looking at this, it'd be like, I see a lot of numbers. This isn't even making sense. 415, I can put in 58 plus another 6,500 if I'm 50 or over. What's this defined contribution? 290 maximum participant. Why is that so much higher than the 58,000? What's going on here?
Yep. So this just shows that if you are, let's just say, for example, if you're a business owner and you are considered a highly compensated employee as a business owner, you can do the 401k, you can put 58,000 into the 401k and profit sharing. But you can also put an additional component into a defined benefit plan. In order to maximize what that contribution limit would be, the maximum compensation that is used would be 290,000 on your W-2. So if you have an S Corp or an LLC or a partnership, you'd want to have your compensation be the maximum. So rather than taking that compensation through K1 and paying income tax on it, we want to make a W-2 290, because then we can shelter a lot of that into your own retirement plan. And we'll kind of show a couple examples of that.
So defined benefit plan.
Yes. So defined benefit plan, this is going to be a form of a future retirement benefit. And so a future retirement benefit, there's a huge difference between a 401k and a profit sharing plan. Those are defined contributions. You're defining either a dollar amount or a percentage amount of contributions. Defined benefit plan and cash balance plan, those are both forms of future benefits. Those are benefits that'll be paid to you in retirement. So at age 65 or later, you will have a lump sum benefit that will pay a monthly benefit for life. And so it's like a pension plan. You're basically putting money into your own pension plan.
So a defined contribution is putting $1,000 a month into a 401k. A defined benefit plan is working for, my grandfather retired from General Motors and had a defined benefit plan. It's where you hit a certain age and a certain years in service, and then you get a check every month. That is a defined benefit plan. There's CalPERS, there's CalSTRS. Those are more in the nature of a defined benefit plan, but you can actually set up your own.
You can set up your own
business, right? So it's mirroring these much larger businesses, and the measure of money that goes in is not $1,000 a month on a 401k, for example, but it is to put in a certain sum of money, a certain quantity of money to give you based on your age, to give you a certain income in the future, right?
Yes. So this is designed to, for a business owner, create a pot of money that'll be available to you, but also to your employees that you're contributing on their behalf. That'll be a pension-like benefit available to them at a certain age. So we're going to talk about the nuts and bolts of that a little bit more, but this is not just for the big corporations. You can actually create your own defined benefit plan for your own corporation.
Good. And I think it's really important to understand the difference between the two. And the advantage of a defined benefit plan is you're not capped at that 58,000 a year. You can put more into it, therefore have more income tax deduction that reduces your overall tax bill. So this is a dual purpose. So setting up a retirement plan in a business on a very high level serves two purposes. Number one, it makes you competitive and provides a retirement for you and your employees. Number two, it provides a very effective tax deferral strategy. Now, this is a deferral strategy. Remember, if you put 100 grand into one of these plans and when you retire, when you take your minimum distributions, yes, you're going to have to pay tax at that time, but you've successfully deferred taxes for what can be decades, which is a very powerful financial planning tool.
Correct. Yep. So we'll talk about the nuts and bolts of that with a couple of these examples and get into the details and the weeds a little bit. And so we're going to talk about a couple different options that might be available to a business owner as to what various options might be for tax deferral and mitigating some of that tax liability. You can start with just a basic profit sharing plan. So a profit sharing plan is just it's attached to a 401k. So a profit sharing plan can just be through a 401k doing a basic deferral of your $19,500 if you're under age 50 plus the additional catch up if you're over age 50. And then you have typically an employer match that's offered. And most plans these days, if you're not doing a safe harbor plan, you really ought to consider doing a safe harbor plan. Otherwise, there's all kinds of additional testing that you have to do if you have too many highly compensated employees contributing to the plan and not enough lower wage earners contributing to the plan. Then you typically are kicked out as a business owner for not being able to fully contribute because you're not doing a safe harbor plan. So with a safe harbor plan, you fall under this umbrella where as long as you're doing a match across the board, whether employees participate or not, you're not going to have all this extra testing requirements by ERISA.
Yeah. So here's the bottom line. Here's what safe harbor means, because a normal person would hear safe harbor. They're like, why are we talking about boats? All right. What safe harbor means is if you don't give your employees a little bit, you get way more scrutiny.
Yes.
So what the government does is they say, listen, people have to save for retirement. And so what we're going to do, employer, if you give your people a little bit, and these are kind of, I don't want to say crumbs, but they're kind of crumbs, right? You give them a little bit, you can get away with a lot more is the bottom line. Not in a negative sense, but you have far more flexibility and you're not subject to the same rules is the bottom line if you give up a little bit for your employees. And yes. I know in our firm, we have a 401k with matching. If you're a business owner and don't have a 401k with matching, I really think it's a gut check because it's a huge retention strategy. And if you say, well, I can't afford it, that's something that you're going to have to figure out as an employer. We're seeing wages, everything I'm reading, wages are going up. We're in this cycle of the cost of labor going up and the things that you have to provide to your labor force increasing. So as a business owner, you need to figure out how to keep your business running when your labor cost is increasing. So that's just a puzzle that each individual business owner's got to figure out for himself or herself. But
and not only that, but this is the safe harbor plan. So not just doing employer matching, but you want to do a safe harbor plan so that you fall under the safety umbrella of all the scrutiny from ERISA. And ERISA and the Department of Labor are who oversees retirement plans. And a safe harbor can either be essentially what ends up being a 4% match, where you're matching, if an employee does 1%, you do 1% up to 4%. So if an employee does their full deferral, you're only matching at the first 4%. That's typically when we analyze our business owners' needs, if they're going to just do a profit sharing or 401k, we would typically say just simply do the 4% match. Now, when we really are dealing with high profitability and high wages where whether you're an S Corp owner and you end up paying a whole lot of extra income tax on your K1, we then start looking at adding these additional components to the plan, such as a 401k with profit sharing with a cash balance plan. If we're going to do that, we then typically reconfigure the 401k plan to be a safe harbor non-elective. That just means across the board, whether your employees contribute to the plan or not, we're going to give 3% of their compensation to everybody. Now, as you were mentioning, Jim, if some employers say, hey, I can't afford this. Well, if income taxes are your problem, you can afford this because this is a deduction. This is a deduction to the corporate taxes. And so this is all a deductible expense that is also an employee retention tool. So the 3%, there's reasons for changing that, which we can get into the nuances, and it'll probably make more sense when we go through the specific example. But if an employer is just going to do a 401k with profit sharing, this gives them the utmost of flexibility because they can easily say, okay, we have a really good year. We're going to do an additional 5% of everyone's compensation. We're going to do an additional 5% to all of their 401k plans. And we're going to make that. And it's nothing obligatory to do in future years. You have a good earnings year. There's no future obligation. It's a deduction to the corporate, bottom line. It's a deduction. And it's also an additional employee retention tool. So that's one vehicle. And then it gets to be a little bit more advanced from there. So if we look, then the next type of plan would be a cash balance plan. Again, this is where it gets to be very nuanced, but very beneficial for business owners. And so business owners that have couple things. If they have high turnover, this is a good potential vehicle. This is a great employee retention tool. It is really excellent if you don't have a lot of highly compensated employees. And so when I say highly compensated, I mean over really about 150, over 150,000 in wages. If you have a lot of employees that are over 150,000 in wages that aren't part of the ownership structure or related family members. Now, if it's, mom and dad and father or daughter, son, or, daughter and spouse, then it's not a big deal. But if you have outside of the familial ownership structure, non-business owners that are also highly compensated, this may not be the right plan for you. This plan works excellent when we have corporations that have maybe husband and wife or, family, highly compensated employees, maybe one or two key employees, and then a lot of employees that are, under the 100,000.
Yeah, Christina, I see this a lot with physicians in private practice. You see this a lot because a lot of their employees don't make over 150. The physician,
Correct.
Like
The
a plastic
physician
surgeon might be making a couple million a year, and then his employees are making, significantly less. So I've seen success with that. Dentists. Yeah. So I think this is really good for professionals, kind of like solo type professionals. If you're in a structure where you've got highly compensated people, as you say, if you're a dentist with a bunch of dentist employees, this may not make as much sense. But if you're kind of a one professional shop, I mean, this is where I see a lot of people. That's just one example, but I see a lot of people gravitating toward that.
Even just the solo employee, single person business, this works great. So again, the only time it really doesn't work is when you have a lot of non-owner highly compensated employees, unless you can just, take them as a group and not contribute towards them. So it's not to say that it's across the board not going to work. It's going to require more analysis. And then also if you have a lot of over age 50 employees, this may not be the right plan for you if you have a lot of what we would say on the older side of employees over age 50. And the reason being is because, again, this is a defined benefit plan. It's factoring on an actuarial basis a particular benefit that'll be available for retirement. There's a maximum bucket that can be filled. And if you're closer to that age, then you have a shorter window to fill that bucket. Therefore, the funding obligation as an employer, if you've got someone closer to age 65, is greater. So that's where if we have a lot of elderly employees, it also may not be the right type of plan for the business. And that's just going to come down to looking at the census and the particular business itself and just determining, is this the best plan for them, or is it going to be too high of a funding obligation for the employer?
But it might be good, a lot of people retire and they do consulting after, if you're consulting and have an S corp where you run all your revenue through, all your income, your business income, business consulting income, this can be actually a very powerful tax deferral strategy. And how much can you put in per year? Oh, what's the maximum?
So that's where it's going to be a wide range. I've had people fund $1 million into their defined
Wow.
benefit plan.
Wow.
So it's going to be done on an actuarial assumption. So as far as the costs go with having this type of a plan, it does require a specific plan document. We do have to have a third party administrator, which most people that have a 401k are already familiar with their company. And we do have to pay to have that administrator set up the plan, which is typically around $2,500. And then also it's going to have an actuarial assumption as to what, based on your income and your revenue, what you're trying to fund and we kind of back into the numbers. And so we do have to pay an actuary to run those assumptions every year. It's not expensive, but it typically is worth it.
And what about somebody who is in the music business and they have an entity and they're, maybe they're deriving a lot of revenue from an online, an Apple Music or a Spotify, and they've written original content, and it's being streamed and they're making money. That's an example of income, right?
Yep.
So you could set up an entity, and if you say, look, I don't really need this $20,000 a month coming in or whatever it is, I could take that revenue and I could put it in a cash balance plan or another type of plan because I have no employees, and really defer a lot of taxes and fund my retirement, right?
Yeah, these are great types of plans for people that don't have, I don't want to say that they're not as good for people that have a lot of employees, because we've got people that are doing them that have 60 employees, but they work even better as kind of like a solo or small family business, because you have a lot more control over what you contribute. What I will say though, is we would typically, again, start with someone that's, kind of in the earlier stages of hitting higher profitability. We would typically start with a solo K with profit sharing before we would go all the way to a defined benefit. The difference is, as we were talking on the previous slides and type of plan, we were talking about 401k and profit sharing. That's where it's completely discretionary, where you're defining your contribution and what you're able to contribute. Obviously, there's certain limits that the IRS sets. And if you're hitting those limits consistently, then we need to look at adding a new type of plan.
Good.
But if you're going to have inconsistent income, we might want to stay in that bucket, because you're not obligated to do a particular funding. If we go to a cash balance plan, this is a type of plan because it's a type of a pension benefit. It's typically a plan that we want to have in place for at least 5 years. And we want to make sure that you're going to have consistent revenue to fund it with some level of consistency over the next 3 out of the next 5 years. Now, if you have a really off year, a COVID year, revenue, you're uncertain, we can pause the plan and stop contributions. But if we start it and stop it, then the IRS is going to scrutinize that as a tax loophole and not something that you intended to continue. So we do have to have that intent with a cash balance plan. So if you just have one anomaly year, this is not the plan for you.
I'm really glad you mentioned that, because this isn't just some tax saving strategy. This is retirement planning. And if you try and twist it and make it into something else, you could have a string of unhappy days. Let me put it that way.
Correct.
So,
so we'll kind of go into a little bit more nuances. So again, the types of plans that what should you be doing as a self-employed or business owner between now and the end of the year? If you are not sitting down and doing tax planning with your CPA, find a new CPA. Because if you know that you're staring down the barrel at a fairly significant tax bill and you're not doing planning for that, then it's really not someone that's doing planning. They're just doing tax preparation. And you should have an advisor that's doing tax planning with you and analyzing what type of corporate structure, what type of corporate plan is going to be best for your situation. It could be a 401k, it could be a solo K, it could be a profit sharing. Those things all have to have plan documents and accounts opened before December 31st. And now the funding of a 401k, when it comes to deferral, that $19,500 or $26,000 if you're over age 50, those deferrals have to be done by December 31st. Profit sharing, you have to have the plan document and the account opened before December 31st. However, it does not need to be funded until you file your taxes. So whether that be in March, if you're a corporation, in April, if you're an individual, or in October, September 15th of the following year, if you file an extension as a business, September 15th of 2022, or October 15th. So all of these, September 15th is really the deadline for businesses per se, if you're on extension. So some of these things don't have to be funded until later. And so that's really what's unique about a cash balance plan and defined benefit plan as well.
Christina, I have a question.
Mhm.
If I'm a business owner and I go, yeah, I need one of these, where do I go buy it? Because I've seen clients use their third-party payroll company to set it up. Okay. And maybe you should talk a little bit about how, as a business owner, do you go to your CPA to set this up? Do you go to a lawyer to set this up? Or do you go to somebody like you who's a certified financial planner to set this up? How do you go about buying this is what I'm getting at.
You actually need to be working with a certified financial planner if you're going to be doing anything more than a solo K or a corporate 401k. So, could you do a 401k and a solo K? Profit sharing, those can all be done with a payroll provider. Are they the best at it? Don't know, but it's simple, it's easy, and it may be what the best solution is to keep it streamlined for you as a business owner. So those can be done with a payroll provider, and it can be done in coordination with your CPA. A cash balance plan has to involve your CPA, your certified financial planner, and you're also going to need to engage an actuary that does all the calculations. And that would be a third-party administrator. Paychex, ADP, they do not do cash balance defined benefit plans as an addition to the 401k. So typically that would mean you're moving the entire 401k. And I know that kind of sounds like a daunting task for a lot of business owners, but you want everything all in one place because the cash balance plan is in addition to, and has to be tested in a combined testing for Department of Labor and ERISA funding rules with the 401k. So you have to have the same third-party administrator do both plans. And Paychex and ADP do not do, most payroll providers do not do pension plans. But this is one thing that I really want to hone in on. If you have a huge income year for 2021, you've got even accounts receivable that are going to come in 2021, but you don't necessarily have the funds to fund this benefit. We can run some actuarial assumptions and we can say, okay, if we were able to fund this, it would reduce our tax liability. You have until you file your taxes. So September 15th of next year, if you filed on extension and took every bit of time you need to fund that benefit, you have until September 15th of 2022 to fund for 2021 and reduce your tax liability. However, you cannot wait and meet with your tax preparer or your CPA next year and go, can we just add one of those defined benefit plans? You have to have the plan document dated, signed, and in place before the end of this year.
So you got to make the deal this year, but you can pay for it next year. You got to set up the cash balance pension plan this year. You can fund it. You can pay for it next year, but you got to have all the paperwork signed this year. Okay.
Correct. Right. Yep. And that's where, if you're looking at buying another, I've had several clients that they just go, yeah, I'm just used to buying trucks and equipment, and I've got a manufacturer, and it's like, okay, you can only buy so much trucks and equipment, but if you had the option, rather than buying trucks and equipment or front loading your expenses, and you had the option to put money towards a retirement plan that is predominantly going to go towards your own retirement and give you a corporate deduction and save you taxes, wouldn't you rather do that if you don't need the expense? So yeah, that's kind of where we want to start having that conversation as far as what are the deadlines. Again, December 31st is the deadline, but when I say December 31st, I can tell you personally, if I haven't started working with the client before December 15th, I'm not spending my time over Christmas putting a plan together for someone. I'm sorry.
I got to tell you, if you guys want to get a kick, whoever watches this, December 31st at about 6 p.m., just drive by any dealership that sells new trucks.
Yes.
And literally there's a line out the door because it's all these guys, and it's typically guys
Trying to get tax deductions.
Yeah, that's right. They're just procrastinating, and then they go out and they buy that $70,000 truck. Now, there's nothing wrong with that. If you're like, well, Jim, that's what I do to save my taxes. I think it's a yes and. So, I mean, I think it can make sense to do those purchases, but I would say that's really not moving the needle, so to speak. To buy a truck for 70,000 or 100 grand or whatever it is. I mean, if you have $1 million income, okay, so you're taking down, 100,000 off your income. You still have 900,000 to deal with, right? And this is where these plans can really move the needle in the sense of make a meaningful difference in your life. And, I'll tell you what, you mentioned if you're old, if you're over 50. I'm 52 this year. And I would say that as you age, it really changes your perspective. And I can tell you that I didn't think as nearly as much about retirement when I was in my 20s and 30s. I'm thinking a lot about it now. So, buying a truck at 52 is not improving my retirement situation, but, doing these types of plans does. So,
yeah. And so these are the conversations right here. If you can go back to that. I'm sorry, go back for a second. Okay. So the deadlines, your year-end tax planning discussion. Tax planning discussion. Moving too quick. There we go. Right here.
All right.
So this is the conversation you need to be having with your CPA and your certified financial planner. What P&L numbers are you looking at? What is your income projected to be? What is your tax liability projected to be? Should there be any changes to the corporate structure? For example, are you a sole proprietor filing a Schedule C, which is highly subject to audit risk? Should you change to an S corp? And if you need to have those conversations before the end of the year, because then you would need to generate a W-2. And so, what is your W-2 compensation going to be as well? Because when you're doing a defined benefit plan, you may say, hey, I already took all this draw. I'm an S corp. I took $400,000 of draw. And I typically only take a $30,000 W-2 just so I can do my 401k, and I don't want to pay the Social Security FICA taxes. But we might do an analysis that says if your W-2 is that $290,000, that maximum compensation, if that allowed us to put 200 of that into a 401k retirement plan for you, would that be of interest, where you're deducting the 290 for compensation? Yes, you're paying the Social Security taxes and FICA taxes, but then you're also putting 200 of that towards your own personal benefit. That's a different conversation, but the W-2 compensation is a function of what the funding will be. And so we need to coordinate with the CPA and decide before December 31st, what does that W-2 need to be to hit the numbers we need to hit?
Yeah, I mean, this is part and parcel. We don't have the A-team slide on here this time. It's on other webinars we've done, but this is really an example of, I would say these are the types of things that fall through the cracks. And I will tell you what annoys me the most is when I've had advisors in the past and I will learn about something and then I will ask them, well, did you know about this? And they say, oh yeah. And my answer is like, well, why didn't you tell me? So I will tell you, there are a lot of advisors that are sitting on information and they're not effectively communicating it. I think that by and large, CPAs are aware of cash balance pension plans. They're aware of these things, okay, because they go to continuing ed. But part of it's just like not quite sure how it works. Then you have to be proactive in the year before, right? The year before actually doing your tax return. So I think this is one of the things that can fall between the cracks. If you're a business owner, you need to pay attention to taxation and finance, because it's not what you make, it's what you keep. It doesn't matter what your top line revenue is as much as it matters what your bottom line revenue is. We all know that as business owners, right? So if you're standing on the street corner all day selling $100 bills for $50, you're going to go out of business. All right. So very important to pay attention to this. So maybe we can talk about, Christina.
We'll just go through a quick example. So let's just talk about this for a second, and we'll go right into the example of one of my clients that I've blocked out some of the information so we can kind of go through a real world scenario, which is probably fairly similar to many people's situations. So this is a quick analysis of funding capabilities. So if you have someone, when you said, what can I fund? This is kind of assuming different age brackets with, obviously a lot of this is going to be based on their compensation. So that's where the W-2 is a function of this. But if we were to make your W-2, if you're 60, we made your W-2 290, we could get total of 254,000 into total retirement plans. And
That's
so,
fantastic.
assume a 50%, California and federal tax rate. That's fairly significant tax savings. And so if we go to this next example where we get really into the weeds on a particular case study, this is where we're going to get into the weeds just a bit, but I think that I'll try to keep it as simple as I possibly can, because cash balance plans are very nuanced. And that's really where if you work with the right advisors and the right team, if your CFP and your CPA are communicating regularly, we can get it dialed in pretty quickly.
Yeah. And by the way, this should be obvious to everyone looking at this. This is why a payroll company would never touch this. It's just it's too complex of a structure. It requires too much detail work and fine detail work. And frankly, it requires too much human effort, for lack of a better term, than those companies are at this time willing to go.
Right. And so ultimately, if we take a look at this, these are the two business owners on top here. So these two business owners, they had a company, and they're 49 and 47, husband and wife. This was the compensation that we had given them for 2020. So this was the W-2 that we worked with their CPA, and the rest of their compensation they took through K1 and distributions and draw. And so we worked with their CPA to back into the W-2s. They did their $19,500 because they were under age 50. They did the full deferral. And then here's the company match, that safe harbor match.
Mm-hmm.
And then you can see that we didn't do a whole lot of profit sharing for them. And we did that for a reason. We gave benefits to all the employees and gave most of the cash balance allocations to the owners. And there's a key difference in a bunch of the ERISA and Department of Labor rules. And there's certain rules that they call discrimination testing. And a 401k and profit sharing, you cannot discriminate against employees. You can discriminate against the owners or highly compensated employees, which they chose to discriminate against themselves as the owners with profit sharing. And they gave extra profit sharing to all the employees so that they could pass testing to get more of the cash balance, where the significant tax savings is as a percentage of the benefits greater to themselves as business owners. This is a business owner driven plan, but not to say that it doesn't come with a lot of employee retention incentives. It does. And so of this entire contribution that they made towards cash balance, 92% of the benefit went to the owners. So they got to, if we scroll to the bottom, and we look at the entire benefit that they did, which was like $176,000 in cash balance. So they made contributions to the employees that were eligible, and there's different eligibility requirements. And they also gave certain profit sharing contributions to those that didn't get cash balance allocations. Now there's a vesting schedule. So anything that's safe harbor, any employee deferrals, everyone should know this, that if you put your own money into a 401k, that's your own money. It's immediately vested. You can't lose that. It never stays with the employer if you leave. That's your own contribution. Any employer matching that's done through a safe harbor match is also immediately vested. That is done, and it stays with you if you leave the company. The profit sharing, that has a vesting schedule with it. And so if we take a look at that, 40-year-old employee, that's like right there, that $2,800, $2,805 that was done in profit sharing. Sorry, go back for a second.
No, it's fine. I get it. Let me just get
that profit sharing, that $2,805 is, if that's an annual contribution, that's not insignificant as a benefit to someone that's making $56,000 a year. That's a decent chunk of change. That profit sharing schedule is going to have a 2 to 6 year vesting schedule. So after 2 years, 20% vests. Then on year 3, 40%, then 60, then 80. After 6 years, that could be a significant chunk of change growing on a tax deferred basis. And that is an employee retention tool. So you not only maybe did the match, if the employee had actually contributed to their own plan, they would have got the match, plus they would have had the profit sharing. And So then we have the cash balance. The cash balance is what's called a cliff vesting. That means after 3 years, 100% of that vests.
And
So-
2 years and 11 months, 0%, right?
Correct. So if you
Right.
leave the company and you've got a, $5,000 cash balance vested balance, you leave it with the company, and that becomes something the company can use towards their obligations towards funding for other employees.
I guess it's they're not quite golden handcuffs. They're like golden thumb cuffs. Like it's a smaller amount, but
Yeah, but I mean, this is just an example of one particular, you can see one particular company. What you can see here that is the trend is that these employees are fairly moderate compensation and younger. And so they don't have a lot of over 50. So this is why this plan was beautiful as a business owner. You can offer some great employee retention tools. You're already doing the matching of 4%. You're doing profit sharing, which maybe gives 5% of their compensation towards profit sharing. But you're able to put in 176,000 as a at the bottom. If we looked at the cash balance contribution, 92% of that goes towards the owners. And if we then add the profit sharing, you're looking at over 200,000 between cash balance and profit sharing. And then if you also add the safe harbor match, because if you're doing just a 401k and safe harbor match with your payroll provider, paychecks, whatever, you're getting those deductions anyways. But where we add bells and whistles to this is rather than as an employer taking a $32,000 deduction, if we can get you an additional 200 plus, and have 90% of that go towards your own benefit, towards your own personal retirement plan, this is where we make a difference. And if we say, hey, we saved you, realistically, we saved you a little over $100,000 in taxes.
yeah, it's phenomenal. And the other thing is we're kind of looking at this in a vacuum because these clients likely have other assets outside of their company. And there's a lot of tax planning that you can do to reduce your overall tax bill, not just the tax bill from the income you're earning this year, but also your investments. Wow. Very, very powerful strategy. And you know what? This again serves a dual purpose. Number one, you're paying less tax as a business owner, but secondly, and saving for retirement, but secondly, this retention strategy. And when the government says you have to do something, and if you don't do it, we're going to step in and do it for your employees. I will tell you that scares me a lot because what that means is, can the government come in and inspect your books? Sure. Right. I mean, there's a lot of, so sort of ratchet is increasing, if you will, more government oversight. So it's not less government oversight, it's more. And really, if you don't have something like this in place, I think as a business owner, you're probably making a mistake not to have it fill some of your headspace and think about it and make a decision rather than just kind of ignore it. So enough of my pitch for being a good
this is just an example.
owner.
Yeah, for this particular business owner, they put in 251,000 when all said and done. And the benefit of that, when you combine the profit sharing plus the cash balance plan, the total benefit was 72% to the owners.
I mean, yeah. So the default is if they did nothing, they pay 112,000 more in taxes.
Correct.
Who wants to do that?
They pay a little bit more, but they're putting towards their own benefit and they're saving money that they would otherwise be paying to the IRS, the franchise tax board. And this does not include their own personal deferrals. So this is just corporate benefits. So this is where adding a if you have a 401k, adding a profit sharing would be step one. Then adding a cash balance plan might be that extra bells and whistles. And it's what's called a cash balance pension plan. And these typically are done as 5-year plans. And then if we want to end that plan and start a new plan, we can. And then eventually those balances can be rolled over to an IRA. They could be maintained as a pension plan. There's a lot of options, but ultimately the nuts and bolts of this is, if you're not doing the planning of what to do to mitigate taxes and discussing these types of plans, that should be your conversation between now and year end.
Wow. Christina, great stuff. Subscribe to our YouTube page now. If you're watching this on YouTube, click that button, subscribe to stay informed. Here's our contact information. If you're like, hey, how do I buy one of these whiz bang 401k cash balance pension plan profit sharing? Contact Ascent Wealth Management at myascentwealth.com. You can call the number there, 805-312-7200. If you're like, yeah, Jim, I need to get my corporate stuff straight or get my estate plan set up or do some other tax planning, please reach out to us as well, Cunningham Legal. And that's cunninghamlegal.com and 530-269-1515.
We have a question here.
Yeah. So Anonymous asks, can the defined benefit plan somehow get to a self-directed IRA? Interesting question.
No, not until the dissolvement of the plan. So because this is a pension plan and there is, even if it's 100%, like let's just say that you're a solo business owner, husband and wife, and it's just the two of you, there's still a fiduciary that has to oversee, like a certified financial planner, that it cannot be self-directed when it comes to a pension plan. You have to try to obtain the targeted rate of return is 5% on a pension plan. And so if anyone's paying attention to interest rates these days, a 10-year treasury bill is paying 1.6, 1.65. So to try to attain 5%, you have to have some equities, you have to have some risk. But 5% is the target rate of return. Now, we can have a higher rate of return, but if the rate of return is too high, it limits the future year's funding, and it then limits the amount of tax mitigation it can provide to the business owner. So some of these types of plans, if you really want, think about it, the best rate of return you're going to get on your dollar is day one, 50% tax savings. So let's call it 45%. So you're getting a 45% return on your money day one. You don't need to have high returns on these to make it worthwhile and beneficial to you. But that's typically why we do these in 5-year plans. And then we would maybe end this plan and start a new one, because maybe the business owner at the end of the 5-year term wants to roll it over to an IRA and then do self-directed investments. They can do that when it's in an IRA. While it's a pension plan for those 5 years, there's a fiduciary obligation to whoever is managing the defined benefit plan, which should be a fiduciary. And there is a targeted rate of return of 5%.
Yeah. So if you end up, because I know sometimes people say, well, I'll put this in the, cash balance pension plan, and I want you to put it in this, hyper aggressive type index or something. The problem is the target return is 5%, which means if it goes down -20, you might say, well, as an investor, I can stomach -20, fine with me. But
then your funding obligation is going to be greater the following year because
that's right. So we have a legal term for this. It's called blowing up. Mm-hmm. So you really need to view this as fundamentally a retirement strategy. In my opinion, you got to view it as a retirement strategy with a really big tax deferral component, with a slight constraint on your investment portfolio for that first 5 years. And so I think that's just going into it. You need to know, eyes wide open. You can't say, hey, I want to invest in pork belly futures or whatever, because those aren't even traded anymore. Yeah. But there has to be this band of range of return to make the plan work.
And it's not to say that we can't get 10%. I mean, I can probably do a 10% for some clients. If they're saying, hey, I'm going to have huge earnings for the next 3 years, I need to be able to have my funding obligation. I need to be able to put as much money in this as possible. Well, the higher the return, it also mitigates how much funding we can put in. So it means that you're going to have a higher tax bill. So there's this perfect massaging of how high can the return be and still give you the funding capacity. And then in addition to that, to your point, if your earnings are very stable and all of a sudden the returns plummet, you're going to have extra funding you have to do to try to bring the returns back up to that 5%. Because if it's below 5%, the plan is going to require more funding. And that's just, you got to think of it like it is a pension plan. Mm-hmm. Think of the CalPERS and the police officers, fire unions, all of their pensions. Part of why they're running into issues is because they have this 5% rate of return and you've got 10-year treasuries at 1.65. They need to take more risk to hit those targeted returns. And so if that is an obligation, in order to maintain that benefit, you can't go in a CalPERS pension plan, you can't go buy pork belly futures or go buy flip homes. You can't do that with people's pension money. And that's how this is looked at from the IRS and ERISA. There's a fiduciary obligation to ensure that that minimum level of 5% rate of return minimum is going to be there. And so you can't take excessive risk. Now, that doesn't mean that on the 401k side, With the profit sharing, you could do a self-directed 401k and profit sharing and do whatever you want, but you have to have discipline on the pension side.
Yeah. So let's give an example. Let's say somebody says, I'm a Tesla person. I firmly believe that Tesla is going to 3x in the near term. Can I just put Tesla I put $1 million in cash balance pension plan. Can I just be 100% invested in Tesla, or is that a violation of?
It's a violation.
It's of the fiduciary obligation. So you would, as you said, you would want to have that stock in Tesla either in your own name or in a 401k or some type of IRA. So that those are different rules when it comes to pension plans. So the government, I guess, in a sense, giveth and taketh away. So any other questions? And then, by the way, remember to subscribe to our YouTube page. We have a great webinar coming up next week, which is the very sad topic of, what happens, can I afford for one of my spouses to pass away, or a spouse to pass away, one of my spouse to pass away. So if my spouse passes away, what does that look like? How does that change things? And I'll tell you a little teaser. When a spouse passes away, you become a single filer. And so your income taxes go up. So if your income remains the same, then your taxes go up because you're now a single filer. So that's just one of many subjects that we'll cover. But if there are no further questions, Christina, thank you so much for doing this with me today. And remember to subscribe to our YouTube page, and we'll see you soon.
Thanks, Jim.